If you own silver, this video matters more than you realize because something just happened that shouldn't exist in a functioning market. Yet there it is, completely visible, a $62 spread, Shanghai paying around $136 per ounce while New York hovers near the mid-70s. Same metal, same atomic structure, same industrial applications, two prices that seem like they belong to different worlds. What's strange isn't just the number itself, it's the silence surrounding it. When spreads this large appear, financial media usually can't stop discussing them. Expert panels, breaking news alerts, urgent explanations. This time, almost nothing. That's precisely why this deserves your attention. Let's slow down for a moment because the immediate reaction is to say that can't be real, or someone must be misquoting a contract. That's how our minds shield us from uncomfortable information. But reports coming from Asia over recent days are consistent. Physical silver premiums in Shanghai have expanded to levels that make New York pricing appear disconnected from reality. Not a $1 or $2 arbitrage gap, not even a $10 panic premium. We're looking at a spread wide enough to drive a cargo vessel through. Before you jump to conclusions, this isn't about telling anyone to buy or sell anything. This is about understanding what kind of market behavior creates something this extreme. Here's the uncomfortable truth. Price isn't the same as value, and it's definitely not the same as availability. Western markets excel at pretending these three are interchangeable until suddenly they're not. Futures markets, ETFs, paper contracts, they're efficient, liquid, sophisticated, right up until physical demand stops caring about sophistication. Shanghai doesn't trade silver the way New York does. The contracts differ. Delivery rules are stricter. The tolerance for "we'll settle this later" is much lower. That alone explains small differences. It doesn't explain $62. So what does? Start with flows, not headlines. Over the past year, Asian demand for silver hasn't been driven by social media or retail enthusiasm. It's been driven by factories, grid upgrades, solar manufacturing, electronics, and a steady bid from institutions that don't need online confirmation before they act. Silver isn't a story metal over there. It's an input. When you need it immediately, not in 6 months after a contract roll. And when supply chains tighten, the price doesn't negotiate. It jumps. Now contrast that with New York. COMEX pricing is exceptionally good at reflecting sentiment. Fear on, fear off. Inflation hot, inflation cooling. Dollar up, dollar down. It's an elegant machine for translating narratives into numbers. But it's far less sensitive to physical stress until that stress becomes unavoidable. Think of it like a pressure gauge that's been dampened to avoid alarming passengers. Smooth needle, calm ride, no sudden movements. Meanwhile, somewhere else in the system, pressure builds. Here's where it gets interesting, and this is what most people miss. A massive spread like this doesn't mean one side is right and the other wrong. It means the market is fractured. It means silver is no longer a single global price with minor regional variations. It's becoming a series of localized markets connected by logistics, regulation, and trust. And trust is the critical word, because when trust erodes, premiums appear. When confidence in future delivery weakens, buyers stop asking what's the paper price and start asking, can you actually get it to me? This is why the silence matters. Large institutions dislike discussing fragmentation. It raises uncomfortable questions. If silver is one asset, why are there two wildly different prices? If arbitrage is supposed to close gaps, why hasn't it? And if it can't close the gap, what does that say about transport, inventory, or willingness to part with real metal? Those aren't questions you want trending on a quiet news day. There's a historical rhythm to this. Commodities tend to whisper before they scream. First, you see unusual premiums in one region, then delivery times stretch, then inventory stops falling smoothly and starts dropping in chunks. Only later does the headline price react. By the time everyone agrees something is wrong, the opportunity to calmly understand it is gone. This isn't about predicting a specific outcome. Markets love humiliating certainty. It's about recognizing stress signals while they're still being dismissed as anomalies. Here's a slightly uncomfortable joke traders tell each other when things get strange. The price is what clears the most comfortable market. Right now, New York looks very comfortable. Liquid, deep, confident. Shanghai looks urgent. Urgency is expensive. Urgency doesn't wait for Federal Reserve speeches or inflation reports. Urgency pays the premium and moves on. That doesn't make it smarter or less smart. It makes it different. What really deserves attention is who isn't panicking. Despite the dramatic spread, you're not seeing forced selling, disorderly markets, or emergency halts. Instead, you're seeing quiet adjustment. Metal moving east. Inventory being reevaluated. Contracts being scrutinized. That kind of calm response usually happens when participants understand something structural is changing, even if they don't fully agree on what comes next. This is where the story gets deliberately uncomfortable because neat endings are overrated. If you're waiting for someone to say, this means silver will do X by Y date, you'll be disappointed. Real markets don't hand out clean scripts. What they do is create tension, and tension is exactly what a $62 spread represents. Tension between paper and physical, between regions, between confidence and necessity. As we move forward, the real question isn't whether the spread closes, it's how. Does New York reprice upward? Does Shanghai cool off? Or does the market accept that silver no longer has a single global clearing price? Each path tells a very different story about supply chains, industrial demand, and the limits of financial engineering. And none of those stories resolve overnight. If this feels unsettling, good. It should. Markets rarely send signals this loud without meaning something deeper. And if you think we've already uncovered the whole picture here, that's exactly the trap. Because the most important part of this story isn't the spread itself. It's what happens when people finally start asking why it was ignored for so long. That's where things start to get really interesting. Because once attention shifts, behavior follows. And behavior, not opinion, is what moves markets. This is where the story tightens. Because once a market fracture becomes visible, even to a small group of people, it stops being just a pricing oddity and starts becoming a behavioral problem. In part one, we talked about the $62 gap and why it shouldn't exist in theory, but markets don't live in theory, they live in incentives. And incentives are changing quietly, not with sirens, but with subtle shifts that only show up if you're looking in the right places. Think about what happens psychologically when you're a large industrial buyer in Asia and you're paying $136 for silver while headlines from New York are flashing prices in the 70s. You don't feel clever. You don't feel like you're overpaying. You feel relieved that you got supply at all. That mindset alone tells you everything you need to know about where stress actually lives in the system. Western traders see a number on a screen. Eastern buyers see a bottleneck. Those are two completely different realities, and they don't converge until something breaks or adapts. Now here's the part nobody likes discussing, because it makes everyone equally uncomfortable. Arbitrage isn't broken, it's constrained. In textbooks, a spread like this is free money. Buy here, sell there, close the gap. In the real world, arbitrage requires metal, transport, time, regulatory approval, and above all, willingness to part with physical inventory. And that last part is where things get sticky. Because when holders of real metal sense that supply is tightening, the first thing they do is stop offering it cheaply. Arbitrage dies not because it's impossible, but because nobody wants to be the last one holding a warehouse receipt instead of bars. You can see hints of this in delivery behavior, not in flashy press releases, but in small operational details. Longer lead times, more selective counterparties, quiet changes in contract language. None of this screams crisis. It whispers caution. And markets whisper long before they shout. The people closest to the metal always hear it first. There's also a geopolitical layer that makes this more than just a commodity story. Silver sits at the intersection of energy transition, defense manufacturing, and advanced electronics. It's not oil, but it's not copper either. It's small enough that flows matter significantly, and important enough that nobody wants to admit they're short. When regions start competing implicitly for the same physical inputs, prices don't just move, they decouple. And decoupling is exactly what a $62 spread looks like in its early stages. What makes this especially fascinating is how clean the surface still looks. Equity markets are doing their thing. Bond yields are grabbing attention. Crypto is sucking up headlines. Silver supposedly is boring again. That's the cover story. Underneath, you've got one of the clearest signals of physical stress we've seen in years, and it's being dismissed as a regional quirk. History is full of moments like this, where the most important data point is the one that doesn't fit neatly into the narrative, so it gets ignored. Let's talk about inventories for a moment without turning this into a spreadsheet lecture. Reported inventories don't collapse all at once. They stair-step, they decline quietly, stabilize briefly, then drop again. Each step gets rationalized. Seasonal demand, temporary logistics, maintenance shutdowns. Individually, all reasonable. Collectively, they tell a story of a system running closer to the edge than advertised. And when inventories get thin enough, price stops being a discovery mechanism and starts being a rationing tool. This is where humor sneaks in because markets have a sense of irony. The same structure that makes paper markets efficient in calm times makes them slow to react when physical reality shifts. It's like using a cruise ship to make a U-turn. Eventually, it gets there, but not quickly and not gracefully. Shanghai, by contrast, trades more like a speedboat. When demand hits, prices jump. When supply loosens, they fall. Less elegant, more honest. Another thing to watch is behavior, not commentary. Are manufacturers reducing silver usage? Not really. Are substitution efforts accelerating? Slowly, but not fast enough to change near-term demand. Are premiums staying elevated? Yes. Are they volatile? Also yes, which is important. Persistent volatility in premiums usually means the market hasn't found a clearing level yet. It's probing, testing, seeing where resistance forms. Here's a subtle but crucial point. When physical premiums rise dramatically, futures prices don't always follow immediately. Sometimes futures lag because they're anchored to expectations, not necessities. Expectations can be managed with words. Necessities cannot. A factory that needs silver this quarter doesn't care about 6-month forward curves. It cares about trucks showing up on time. This disconnect creates a strange emotional environment for participants. On one hand, everything looks normal. On the other, nothing feels normal. That's the stage where mistakes get made because people either overreact or dismiss signals entirely. The middle ground, observing without committing to a neat conclusion, is uncomfortable. And discomfort is something markets are very good at generating. If you're wondering why more people aren't talking about this, the answer is simple and unsatisfying, because it doesn't resolve cleanly yet. Media likes outcomes, silver surges or silver collapses. A structural divergence between regions doesn't fit into a headline that drives clicks without explaining too much, so it gets sidelined. Meanwhile, professionals quietly adjust. This brings us to the tension we're deliberately not resolving yet. A spread this large forces a choice eventually. Either physical supply loosens, or paper pricing adjusts, or the market accepts fragmentation as the new normal. None of those options happen instantly, and all of them carry secondary effects that ripple outward. That's why this isn't just a silver story. It's a story about how modern markets behave when physical constraints reassert themselves in a system built on abstraction. As we move into the next phase of this discussion, the real question shifts from why is the spread there to who can afford to ignore it and who can't. Because markets don't move when everyone understands something. They move when understanding is uneven. And right now, understanding is very uneven. Some participants are acting as if nothing has changed. Others are behaving as if everything has. That imbalance is where the next act begins. Because once behavior diverges far enough, price eventually follows. Not as a prediction, but as a consequence. And in the final part, we're going to talk about what happens when attention finally catches up to stress, and why that moment is rarely calm, rarely intuitive, and almost never arrives with a warning bell. This is where everything we've talked about quietly converges, because once attention finally turns towards stress, markets don't respond politely, they don't move in straight lines, and they don't reward people who waited for perfect clarity. In part 2, we left off with an imbalance. Some participants acting as if nothing has changed, others behaving as if something fundamental already has. That gap in behavior is far more dangerous than any single price spread. Because behavior is what forces repricing, not opinions. When attention shifts, it rarely shifts evenly, it snaps. One moment, the $62 gap is a curiosity buried in regional reports. The next, it's being referenced on trading desks as a known issue. That phrase matters. Known issue doesn't mean solved, it means acknowledged. And acknowledgement is the moment narratives start to break down. Because once people agree there is a problem, they immediately disagree on what it means. Some will say it's temporary, logistics-driven, a hangover from supply chain disruptions that will fade. Others will say it's structural, a sign that paper pricing has drifted too far from physical reality. Both camps will have data. Both will sound confident. And silver, as it loves to do, will refuse to validate either side cleanly. Instead, it will create volatility in places people least expect and calm in places they're watching too closely. Here's the part that makes professionals uneasy. Fragmentation doesn't need to become permanent to be impactful. Even a short period where regional prices diverge sharply can change behavior long term. Contracts get rewritten, counterparties get reassessed. Risk managers add footnotes that quietly alter how much exposure is considered safe. None of that shows up in price charts right away, but it changes the plumbing of the market. And once plumbing changes, flows follow. Another subtle shift happens at this stage. Trust becomes selective. It's no longer about trusting the market. It's about trusting specific venues, specific contracts, specific delivery mechanisms. When that happens, liquidity thins in unexpected places. You don't get a dramatic collapse. You get moments where bids disappear, where offers widen, where price jumps feel unearned. Traders call this air pockets. Viewers just call it weird. And weird is exactly the right word, because if silver were truly abundant and freely flowing, a $62 spread wouldn't survive more than a heartbeat. The fact that it has, even briefly, suggests friction somewhere that price alone isn't resolving. That friction could be physical, regulatory, or psychological. Usually it's a mix of all three. Markets are human systems dressed up as math, and humans don't behave optimally under uncertainty. There's also a timing element that's easy to miss. Structural issues tend to surface when attention is elsewhere. Right now, macro focus is split across interest rates, currencies, geopolitics, and technology. Silver sits just outside the spotlight. That's not accidental. Crowded attention smooths markets. Divided attention exposes faults. And once attention swings back, it often does so with a sense of urgency that feels sudden, even though the groundwork was laid quietly over weeks or months. What happens next doesn't need to be dramatic to matter. The spread doesn't have to explode further. It doesn't even have to persist at $62. A partial closure can still leave scars. The key change is perception. Once participants accept that regional pricing can diverge meaningfully, they start planning around that possibility. Planning reduces supply elasticity. Reduced elasticity increases the market's sensitivity to shocks. That's how small issues become big reactions without a single headline-worthy event. Here's the part that keeps this story unresolved intentionally. Because markets don't move on conclusions. They move on tension. Right now, there's no clean signal telling us which side of this divergence ultimately forces the adjustment. That uncertainty isn't a flaw in the analysis. It's the analysis. Will physical premiums compress as supply quietly loosens and logistics catch up? Possibly. That would suggest the stress was real but temporary, absorbed without dramatic repricing. Will futures markets adjust upward to reflect scarcity, admitting slowly and reluctantly that paper pricing lagged physical reality? That's another path. And it wouldn't arrive with fireworks. It would arrive with a series of unexpected moves that analysts explain after the fact. Or does the market settle into something far less comfortable? An uneasy compromise where price becomes contextual, dependent on geography, urgency, and access, rather than a single global benchmark. That outcome doesn't break the system outright, but it subtly rewires it. Each of these paths reshapes behavior in a different way. If premiums compress, participants learn that patience is rewarded. If futures reprice, they learn that physical stress can overpower narrative pricing. If fragmentation persists, they learn that silver is no longer one market, but many loosely connected ones. Here's the critical detail. None of these outcomes announce themselves in advance. There is no bell, no headline that says, "This is the one." You only know which path you're on once you're already halfway down it. Silver has a long, almost mischievous history of embarrassing certainty. It doesn't just move against consensus. It waits until consensus becomes comfortable. The moment enough people agree on what something means, silver has a habit of doing something else entirely, often in a way that doesn't immediately make sense. That's why the most dangerous position right now isn't being wrong. Being wrong is survivable. Markets forgive wrong. What they punish relentlessly is being too sure. Too sure that this spread signals an imminent breakdown. Too sure that it's meaningless noise. Both extremes create blind spots, and blind spots are where losses hide. This is why professionals tend to sound frustratingly vague at moments like this. It's not because they don't see the issue. It's because they see too many possible resolutions to commit to one publicly. Certainty sells content, but it's terrible risk management. Real market awareness lives in probabilities, not predictions. And probabilities feel unsatisfying when you want a clean answer. So where does that leave us? In a place most people dislike deeply, watchful uncertainty. The kind where you observe more than you act, where you notice small changes in language, behavior, and flow, rather than waiting for a single decisive event. The spread between Shanghai and New York isn't a verdict handed down by the market. It's a question, a loud, uncomfortable one, a question about how global this market truly is when stress appears. A question about whether paper and physical are as interchangeable as pricing models assume. A question about how quickly modern financial systems adapt when old assumptions stop working as advertised. And those questions matter beyond silver. They touch on how commodities are priced in a world where logistics, geopolitics, and industrial demand don't move in sync. They challenge the idea that liquidity always equals availability. They expose the difference between something that can be traded and something that must be delivered. Those distinctions usually don't matter until suddenly they matter enormously. If you're still watching at this point, it's probably because something about this doesn't sit right. Not in a dramatic, panic-inducing way, but in a quiet, nagging way. That's not fear. That's pattern recognition trying to assemble itself without enough data yet. The mind senses inconsistency before it can explain it. And that discomfort, that sense that the pieces don't quite fit, is exactly where the most important market moments begin. They don't begin with answers. They begin with questions that refuse to go away, with prices that behave oddly, with spreads that shouldn't exist but do, with silence where there should be commentary. That's the stage where outcomes are still flexible, where behavior is still adjusting, and where most people would rather look elsewhere. Because when everyone finally starts talking about a $62 spread, the spread itself may no longer be the story. By then, it will just be evidence. The real story will be how the market adapted while attention was elsewhere. Who adjusted early? Who waited? Who assumed normal rules would reassert themselves automatically? And by the time that adaptation becomes obvious, silver will already be somewhere else, as it usually is, leaving behind a trail of confident explanations that only make sense in hindsight. That's how markets work. They move first, explain later. And the people who sense the shift before it's obvious rarely feel clever in the moment. They feel uncomfortable, unsure, and slightly out of step with the crowd, which historically is exactly where you tend to be standing right before the narrative finally catches up.